Okay, so picking back up with Learning Objective 4, let's now think about the procedures. So, talked a little bit about what audit risk is and audit evidence, assertions. Now let's think about actual procedures. And the auditor has different tools at its disposal, or his or her disposal. And if we look at some different categories of audit procedures, we're going to have procedures that we do during this phase called risk assessment, and that's trying to understand the risk of material misstatement, right? So understanding inherent risk, understanding control risk, and so that's going to be trying to assess the risks on the front end. And then once we've assessed those risks, then we need to go in and decide, do we want to test the internal control system using these tests of controls. So that is because we want to decide whether we want to rely on the internal control system of the firm for catching some problems, or do we want to just move almost all of the work to the audit and manage the detection risk to make up for the lack of knowledge about the control risk through the internal control system. And so those are called substantive procedures. And so we can do a couple different kinds there, analytical procedures, and we can also do tests of details. And we're actually looking at the account balances, transactions, disclosures, and then looking at the individual, for example, transactions that go into those accounts. And we'll talk about different ways we can test those as we kind of move along. But those are our kind of three categories of audit procedures: risk assessment, and then control testing and substantive testing. So here's some examples, and these are going to make more sense as we're going through the different transaction cycles. You'll see why we're doing each of these, but here's some examples. Inquiry is a very common one where we're actually talking and interviewing key personnel within the company. We can get some external confirmation. So, for example, if our client has debt, has accounts receivable, we could send a confirmation to its big customers and say, hey, our client says that you owe them money. Can you confirm that? Right? And we'll get into that as we kind of move into the revenue cycle. Inspection, observation, recalculation is a very common thing that we're going to do. We're looking for simple things like a vendor invoice, or an invoice that we're going to bill, that our client is going to bill our customer. Well, we just look to make sure if you have quantity, you have price, and they have subtotal. Let's imagine there's multiple products on that invoice. Just want to make sure that those calculations are correct. Reperformance is where we might execute a certain set of procedures that were performed by the client. Could be related to internal controls, could also be related to different accounting methods that require calculation. Think about all your intermediate two things that you had to do, all those journal entries, and so that might be where you have to reperform the same procedure to see if you got the same answer as the client, right? Analytical procedures, well, we'll talk about in a little bit more detail in a few minutes. And so, anyway, there's different procedures that are available to the auditor in its kind of bag of tools. And again, as we kind of go through the different transaction cycles, especially, you'll see why we're doing some of the ones that we're doing. And again, this just a reminder about the substantive procedures, so we can kind of break this down into a little bit more. We said that included analytical procedures and tested details, but kind of breaking out the details into a little bit more. We can do tests of account balances, and we can do tests of classes of transactions and tests of disclosure. So, and we'll talk about as we go through when you might want to do an account balance test versus a classes of transactions test. Obviously, for disclosures, we're looking at footnotes and making sure that those footnotes accurately reflect what's going on in the firm. So think about I think you learned about segments, or hopefully, I don't know if you actually learned about segment reporting, but if you didn't, segment reporting is just where companies have to split out their operations across the segments. And there's a footnote that does this. And so one of the things we would do as auditors is test and make sure that that footnote lines up with the evidence that we have, in this example, around the different segment performance. So how can we change and modify these audit procedures based on the risks that are present? And so we change them by changing the nature, timing, and extent. So the nature is the type of procedure, the form of it. Timing is when we actually choose to perform it, and then the extent is how much evidence we want to obtain. So, for example, we'll talk about sampling at some point. How large of a sample do you want to take would be related to extent. Timing could be related, or would be related to when in the client's fiscal year are we performing the services, and then nature is, remember, based on those categories we had, right, of audit procedures, which of these we want to take as our test. That would be the nature and form of the test. We can vary based on the risks that we need to deal with. And so this slide just kind of gets into a little more detail there. The only thing that's kind of new here is the other thing we might change for the nature is, are we going to get externally generated evidence versus internally generated evidence, right? In order to get more reliable evidence. Or are we going to do recalculation instead of just inquiry, for example? And then timing, I said, is when during the client's fiscal year are you going to do it? Are you going to do interim testing, which is during the fiscal year, or are you going to wait until year end to obtain evidence after the year end has finished? And so both of those represent different amounts of timing. And so after year end would be considered a higher level of reliability for evidence, because if you test it during the year, there's a chance they could go back and try and manipulate it after you've tested it. And then extent, again, the main way is related to the number of items and sample size, and so that's just a little more detail, or saying in words what I've already kind of said in the previous slide. Oop. Okay, so we were talking about substantive testing having three components, and we talked a little bit about the tested details and tested accounts and disclosures and how to modify those. Remember that other big category is analytical procedures. And so this can be done, so technically analytical procedures can be part of substantive procedures, which we just mentioned, but it can also be referred to as risk assessment. It can also be included in a risk assessment, and it can be included in the final review that's done after the audit is completed and the partners are doing their final review. And so you can use, and oftentimes will use, analytical procedures at several different points throughout the audit, not just in the substantive procedures like we were referring to earlier. And so how do you do analytical procedures? And to be clear, analytical procedures are done at the account level. They're not done at the transaction level. Okay? And so analytical procedures, generally what you're going to do is you're going to select one of the significant accounts from the financial statements. Let's say it's revenue, and you'll develop an expectation of that balance, right? And so let's say you expect revenue's been increasing by 5% the last 3 years, and so that could be a good expectation, is that you would expect it to grow another 5%, right? Then once you come up with that expectation, you decide, well, how much of a difference am I willing to tolerate without me having to dig further into the into the details of the transactions. And usually this is we're gonna do this for several accounts. In some accounts, this may be the only audit procedure we do. If it's a small account, it's not very material to the firm's financial statements, then it's possible we could just do analytical procedures and not actually do any test of details or test of transactions. And so we're going to think about what's our tolerable error, right? That's the amount of difference that we can accept. And then we're going to basically compare the company's account balance, actual account balance for this year with our expectation that we created, and then identify the differences and then determine whether it's significant or not. So if we have a significant difference, we're going to have to dig into it more deeply in order to figure out what happened. So let's say revenue, instead of being up 5%, was down 2%, or excuse me, let's say it was up 10%. And so then I'm worried about, is it overstated, right? And so analytical procedures help me kind of identify potential problems. So there's different ways to come up with that expectation. It could be prior periods. It could be management forecast. It could be how different financial statement elements move together, right? So think about accounts receivable and bad debt expense, right? So it should be, as accounts receivable is growing in absolute amount, then probably bad debt expense should be growing too, right? And if we see accounts receivable growing, but all of a sudden bad debt expense is going down, then that's kind of contrary to how the financial statements typically work. And so that would give us um, uh, a way to develop an expectation is based on how the other elements in the financial statements are moving or changing. It could be you bring in information about the industry. If the industry as a whole is struggling, then you would expect your client to probably struggle, at least relatively. And then we could bring in some non-financial data as well, right? So if we financial here just means things that make it into the financial statements. So if you have like a hospital and you've got patient revenue, well, if you had data on the number of beds that were filled with patients during the year, right, and you let's say you have that for multiple years, then you should see a pretty direct correlation between the number of beds and the patient revenue, right? And if you don't, or if it's a weaker relationship this year compared to other years, then all of a sudden that makes you, excuse me, kind of pause and wonder if there's a problem with the financial statements. Okay, so anyway, these are different ways in which we can develop that expectation. And so how might these analytical procedures look? Trend analysis is one way where, again, what's the expectation? The expectation is we're going to see a similar trend to prior years, right? And so if I look at changes in accounts over time, then that helps me develop an expectation and then evaluate that expectation in the current year. Ratio analysis is another one where we're looking at things like debt to equity ratio, gross profit percentage could be one, inventory turnover, right? Those are things that when you're looking at relationships or ratios between different accounts, then you should see some similar performance across time. And if not, then you start to ask the question, okay, what's different about this year? What is it that could have impacted this ratio to be different? Okay, leverage is lower this year. How is that? Well, maybe they were able to raise a bunch of equity, right? They had a seasoned equity offering, and all of a sudden now the equity has gone up a lot. So that ratio, that denominator has gone up, which means the ratio has gone down, right? So you're looking for abnormal values, in this case ratios, and then trying to understand the explanation for those. And so I've largely been talking about there are different approaches to ratio analysis. I've largely been referring to the horizontal analysis, which is when you're looking at ratios over time. But you could look, for example, at other firms at the same point in time. It's a cross section, right? You have a cross section of firms. So if you look at your client compared to all the competitors in the industry, what do their ratios look like? That would be a cross sectional analysis. Again, a different way to set an expectation. A vertical analysis is when you're looking at within one period um, what is going on within the financial statement uh, accounts. And so what you look at is for a given financial statement, um, you can create these common size statements. And common size just means instead of showing the dollar amounts, what you could also show is the relative percentages for each financial statement line item. So if you looked at an income statement, it probably makes sense to put the denominator as revenue. And so your top line would have revenue, and that's 100%. And then from there, going down, you would just take for example, cost of goods sold, what percentage of revenue is that? And then you would show it as the percentage of revenue. And you do it for all your expenses if you had any other non-operating income or whatever it is, and you would put that in and see, okay, does that make sense? Does it make sense to have, um, this line item being this percentage of sales, for example? Do the same thing with a balance sheet. You could use assets, right, as the denominator, and then express the entire balance sheet as a percentage of assets and see does that make sense, or does it, or look to see, well, where are the areas, what are the significant accounts, right? So if PP&E makes up 70% of your assets, then you better make sure, or your client's assets, you better make sure you spend a significant amount of time on PP&E. Okay, there's other ways to do kind of analytical procedures. You could do regression, where you could use a time series of firms, financial statement amounts. You could try and predict the current period's financial statement amount using regression analysis, and then evaluate how good that prediction is. How different is it from what has been going on in the past, right? Um, so it's just different ways to use kind of the high level financial statement account balance information to identify risks. And then here's just a figure you can kind of look at some additional analytical procedures as examples, and what misstatement they're trying to find using the analytical procedure. So I'm not going to go through these, but feel free to look at these for examples, and go ahead and pause if you need to the video lecture and check these out. Okay, and then these next couple slides are just kind of showing how you could potentially manipulate ratios based on adding different types of transactions. So the first one is adding a credit sale. And here, if one of the key ratios that auditors or management uses would be the ratio of sales to accounts receivable. If you had a credit sale, then it reduces the ratio, right? Because it's making your denominator bigger. And that kind of that overshadows making the numerator bigger, right? If it was a cash sale though, then it would have the opposite effect, right? Where you're just increasing the numerator, and so you could see how there could potentially be some intent to, or there could be some incentive to manipulate this transaction if you're trying to manage to this ratio. And so it's just a reminder of how, when you're, depending on what part of the ratio you're changing, that might increase the ratio if it's just impacting the numerator. It decreases the ratio if it just impacts the denominator. But then if you increase both by the same amount, numerator and denominator, then it really depends on whether that ratio is greater than 1 or not. If it's greater than 1, like in our previous example with the sales to AR, then it will decrease the ratio, right? Because the denominator has a bigger effect than the numerator. If the ratio is less than 1, then it could increase the ratio. So again, it's just things to keep in mind as auditors as we're going through looking for these potential problems, because some of the way in which you manipulate the transaction will impact the performance metric you're looking at. All right, so look at this problem 57, 5-57 during a class session. So our next learning objective 5 is about data analytics. So how is that impacting auditing? I think you've probably had some exposure to how it's impacting business. Let's think about how it would impact the auditor's job. So obviously analytics is the process of using these data sets to get insights into decisions. And the key is decisions, right? We're trying to bring information, um, and the definition of information is data that is relevant, that's relevant for a decision, right? So there's a decision context which is necessary. So we do have public accounting firms that are using analytics a lot more to improve their risk assessments and their testing. And so we can use other sources of data that would be available to help evaluate in the risk assessment. For example, control testing, we can actually extract evidence from, for example, a large ERP system in order to test all of the control items to make sure every transaction follows the control, as opposed to just using a sample, which is what we had to do before. And then lastly, we can improve substantive procedures by, again, we can collect data, whether it's through the firm or from outside the firm, to actually test transaction amounts, right? And the nice thing about analytics is that we can get 100% of the population. That's one of the big advantages it has over analytical procedures. Okay, and these two often get confused. Again, analytical procedures are at the financial statement account balance level, whereas analytics are at the transaction level. They're much more detailed. And so analytical procedures, I might look at revenue in terms of the account balance, how it's changed over time. But with analytics, I'm going to look at every single revenue transaction and look for issues. For example, if they had to be, um, sales over a certain amount that were where customers were given credit, was there an approval there? Right? Using analytics, we can actually test all of the transactions to see was that control there. Okay, so again, this is at the transaction level, detail level, and we're going to get some experience with this with some of our projects.